Welcome everybody. This is Brijesh Dalmia from Master Stroke. Thank you so much for Usha for joining.
Thank you, Brijesh, and thanks to the whole Master Stroke family for having me here. Thank you very much.
Thank you so much, and I welcome all the participants who have joined in from all across the country. Thank you so much for giving such a warm applause. Today we are going to talk about global investing, and we have with us Usha Nair, Head of Sales, DSP Mutual Fund. So Usha, let us start with understanding. In the recent past, we are seeing a lot of interest in global investing. What could be the possible reason for that?
So thanks, Brijesh. A very nice way to introduce the topic and one of the most valid questions. So I'll just start with a small statistics. I was just reading a couple of days back. In the last 1 year alone, maybe in 2020, we had about 29 mutual fund schemes, which allowed you to participate in the global market. And in 1 year, we added another 12 schemes. So the number today is about 41 schemes. And if you would have seen the recent, news in the media and also some of the mutual funds, including DSP, we have circulated, the limit for overseas investing, which is close to 7 billion, which in rupee terms is about 55,000 crores, is already touching. And RBI has been approached by SEBI saying that you have to allow us to enhance the limit for the mutual funds for overseas investment, because RBI has a role to play since it has dollar rupee convertibility and all of that. So you need RBI sanction as well. So that's where we are. And so your question is so valid that why suddenly the interest? A couple of reasons for that. Global investing was always something that mutual funds encouraged. And some of the mutual funds have had a very long track record on the schemes, DSP being one. I do recollect Aditya Birla having some of the schemes because I've worked with them. I know some of their schemes. Maybe some of the other fund houses also would have had, because it brings a very different, correlation to your portfolio. So global investing or global equity is an asset class in itself. I would say equity is the only common word. But a global equity, most often, I would say, except in situations like 2020, the COVID correction, or the 2008 global financial correction, it does behave very differently from the way our domestic markets work. And there is enough and more statistics. If you take calendar year-wise return, etc., they do show very different performance. I mean, when our NAVs are down, it is up. When they are down, we are up. So it brings a different flavor to the portfolio, and which is what you want as a portfolio advisor, a constructor of portfolio, which everyone on this call is more knowledgeable than I am on that aspect. So you would appreciate that, which is why we added asset allocation. The word itself is Bible or, Bhagavad Gita to us most often. That's one reason. Two, a more, I would say a more behavioral reason, Brijesh Ji, is the last 10 years, when you look at the market performance, the US market particularly has done far better than any other market in the world. So if you were to take the world indices and rank them, maybe from 2011 to say 2020, and even the post-COVID rally that happened, the US markets are somewhere up there, and then the rest of we have also done well. But there's interesting data, 20-year return, 2000 to 2010 and 2010 to 2020, the difference between Indian market and US market is so stark. The first 10 years of the 20 was favoring India. The next 10 years, your portfolio actually underperformed if you didn't have a global equity, predominantly the US equity in your portfolio. So that has got a lot of interest. People are talking about it. And we as consumers became aware of these Apple, Microsoft, Google, because our consumption of these stocks increased. And that also led us, so to you as an advisor, to talk to me as a client about a Google, you don't need to introduce why you should invest in Google. 5-10 years back, for an advisor like you also would have been a little difficult to introduce that concept. So that's more behavioral, because return is making you look at that market. But I would say fundamentally, advisors like everyone who's part of this family today and many others are understanding the need to diversify. The ability of Indian businesses not competing in the global space is making us look into the global market, and awareness is increased due to media, due to reports, due to sessions like this we do, so on and so forth.
All right, interesting. So why should one invest into the global markets? What should be the prime reason? Should it be diversification? Should it be looked into an equity asset class or some other reason, maybe currency hedge? What is the prime reason? Because many mutual fund distributors and investors are confused. They are
Yeah,
already investing in Indian equities
right,
and American equity. If they invest, वो भी share बाजार है, ये भी share बाजार है. Returns on investment will be more or less correlated. But you
right,
made an interesting point that they are not correlated.
right.
What are the parameters one should consider before
Yeah.
they invest in global?
Okay. So आपने काफी सवाल पूछा है ब्रिजेश जी in one question and very relevant points, the classic master stroke style, which is why you are what you are. So let me take one by one some of them. So the first question you asked is, what is the primary reason to invest? You know, is it diversification? Is it a low correlation, etc.? The first reason I would say is that owning of businesses which are quite run differently from a business model perspective itself. So let's just take an example. What is our Nifty largely composed of? 40% of Nifty is, and Nifty being the broader index that we track, and many funds replicate Nifty or perform with Nifty as a benchmark. 40%, 35 to 40% of Nifty is finance and banking stocks. So that's what I own when I'm buying any fund benchmarked against Nifty. It's not necessary it should be a large cap fund. Even a flexi cap fund or a focus fund or a large and mid cap fund would have somewhere 35 to 40% allocation to finance. The next highest sector in Nifty would be about the software sector, because these are also India's largest. And then you add a Reliance Industries, which would be a 7-8% kind of a weight to the index. Your universe is restricted to these kind of companies, which are very traditional, conventional businesses. Nothing wrong with that. They're well-run businesses. They are India's best 50 companies, so on and so forth. That is what 80 to 90% of my, or I would say even 98% of my 20 lakh crore AUM has gone into over the last many, many years. But today we are doing this call on Zoom. We know we all buy products almost every day on an Amazon. We all use Microsoft, at least a PPT and Excel and Word we use. Some of us also use many other services of Microsoft. So these are businesses. Now they are technology, non-technology, whatever you call it. But they are businesses which are not replicatable in the Indian context. We don't have such large corporations in India. Their business growth, their business model is very different. How do I, and they are also the businesses that are making a change into the future. So how do I make my portfolio future ready? I look at asset allocation, I look at history, I look at rolling return. They are all little backward looking, but that's the way I have to create a portfolio. Also, as a good advisor, I make my portfolio to participate into the future. Technology, innovation, new ideas, new ways. So I would like to use just one word, which is changing business model that is happening. Simple example, Netflix as a company is making news today, stock prices have corrected, etc. But let me just add a point. Netflix is not a technology company. Amazon is not a technology company. Amazon is my mall coming to my home. Netflix is my theater coming to home. But they use technology to bring these two services to my doorstep. How do I, and those are in some ways becoming the dimension of the future. So how do I participate in such businesses, which is largely emerging in the global space, changing business dynamics, which is not the conventional business model of Indian equity investors used to. And that is one primary reason to add something to my portfolio. The second point, which you very rightly, summarized for the benefit of the audience, is the low correlation. The market corrects very differently. When Indian markets perform badly, 2013 is a classic example. 2018 is a classic example when we had the IL&FS-led crisis, etc. Our markets, but the global markets didn't correct. 2013 was a macro problem for us as a country. It was not a problem for the global market. That year, the US and the global markets did very well. So there is, I can go on and on different timeframes, but I'm sure the audience gets the pitch. So the debt and equity, if they are uncorrelated, gold and equity, if they are uncorrelated, largely the global market in India are uncorrelated, except for circumstances like COVID or global financial crisis, etc., which affects the whole universe. So that's a second reason. The third reason is most important from an equity investor, the return potential of these businesses. If they are garnering market share, if they are growing faster than the Indian business, if the business model is sort of disruptive, then the ROE and the kind of balance sheet and profit and loss numbers which are important for a company's performance is very different in the global context. The valuations are usually quite attractive. India is a very narrow market. Global market is much more deeper and vaster, and that also brings you more choices from an investment perspective. So if I were to summarize, Brijesh, for the benefit of the audience, the diversification of the business model, the choice that you get geography wise, and the low correlation are the most important factors that would make me as an investor or an advisor consider global portfolios.
This is very interesting, Usha. The three main reasons that you gave did not have performance or the returns.
Yeah.
And I want to make this point to the audience that when you are suggesting portfolios or investments to the clients, returns are not always the only thing that you have to suggest. Because if clients are investing in debt, they're not going for returns, they're going for safety and kind of protection of money. And Usha here is saying that the main three reasons to invest in global market is not performance. They are something else. So do not always consider returns to be the only factor when you are diversifying abroad. Is this a right conclusion, Usha?
Yes, of course it is. It is. You very correctly said the reason I look at debt is not for return. I do debt allocation. The word you use is debt allocation. You bring the terminology asset allocation, the composition of the portfolio. Global investing, while it is in equity, as an equity asset class, you do expect higher risk-adjusted returns, which you can argue you will get it in the Indian context as well. But that is not the reason. The reasons are something else which I referred to, and you're very apt in pointing that out, that it is not for higher return that we are looking outside the domestic equity region.
Right. You also think that currency is also a reason one should diversify, even though you are staying in India, but you have to have some exposure because India has an inflationary trend.
Correct.
And it seems to be continuing that way if we have to be, competitive. And if you invest in global markets, mostly they are dollar denominated, and that protects the Indian currency. And actually you benefit if the Indian currency devaluates.
That's right. Absolutely. So I would definitely say that for all of us who do have certain aspirations, sort of educating your children abroad, or sometimes later in life, you make a travel, whatever is the plan. And usually, I'm sure most of you agree that many clients today say the education abroad being a goal for many parents, etc. So any asset which is indirectly investing in the global market, helps you to benefit from the dollar strength that you have. And you look at it for decades. India is a currency that does depreciate. Maybe certain periods of time it is a little sharper, some volatility could bring in, but you can do 10-year, 5-year return on the currency and see the movement of the currency. You do add 2 to 3%. So a lot of times investors and advisors do ask this question, that is currency depreciation one. So we have done a lot of analysis to say that if you have made a 20% return, what composition is from the performance of the fund and what composition of that 20 has come from currency depreciation. You're right. Many times it will be in the range of, say, 10% of the return could be in the currency appreciation range. Some years it could be a little higher. Like today, the currency is a little more weaker due to global factors. So maybe that would be, different from that perspective. But currency is a factor and it's an advantage. As long as we are in a developing economy, we do have a little bit of currency advantage, I would say.
Absolutely. And I think, I remember one conversation with a friend of mine many years ago, and he said that I am investing abroad in dollars. And I asked him this question that when Indian markets are doing so well, why do you want to diversify to international market? And his answer was, after 15 years, I will send my son or daughter to study abroad, and I need to protect the currency because if rupee devalues, then I may not have enough money to send my daughter abroad. So this is also an important point mutual fund distributors can convey to their clients, that don't only look for return. If you have expenses in dollars in the years to come, this is a good proposition to take exposure in global funds.
That's right. Because also, Brijesh, just one quick point there. Most of us don't have any dollar income. 99% of our clients, and all of us also, we don't have dollar income, but the aspirations do exist in dollars. So that's the the good or the bad part, whichever way it is, right? So that's important to consider the point that you just raised.
So we are getting a few questions. So if you have any question, the audience, please write your questions in the Q&A box or even the chat box, and we'll take up after this call. Usha, so DSP has a few global funds with the tie-up of BlackRock. How is your new offering different?
Yeah.
And what is the theme of the new offering? Why should investors consider this?
Sure. Thank you, Brijesh. That's a very nice question from the old to new. So DSP has had partnership with BlackRock for about a decade, and somewhere in 2018, both of us parted. So unlike most partnerships, it was a very, very nice, amicable partnership. And we still do benefit from our long-term association with BlackRock in terms of research exchange and support run by their fund managers. Now, as most of you would know, BlackRock is in world's largest mutual fund house. Their size has just crossed 10 trillion assets under management. So they are that large in the world. Because of our partnership in those years, we introduced a few global funds to the market. I would say majority of them, barring one, was a thematic idea, like a mining fund, a gold miners fund, an energy fund, etc. Because in those days, even today, some of these specific sector funds, especially the old economy stocks, the global size and scale is of a very different nature. And since BlackRock had these funds, we partnered with them. People have taken advantage of that at certain segments of time, because these are not all evergreen ideas. There are certain periods when these funds become very attractive, and customers and advisors have taken advantage and continued with that. Those funds still exist. What we understood in our research late, and this is something that we have been, sort of creating for the last 1.5 years, the design of the portfolio, we understood that the reasons that I mentioned earlier, many of the companies that are likely to be the winners of tomorrow, if for want of better example, I'll still go back to the same Facebook, Amazon example, because that's something that we all understand well, both as a consumer and as an investor or as an advisor, is that these businesses from nowhere 10 or 12 years or 15 years back came, and just they are dominating the world today. So just to give one perspective, Brijesh ji, Apple's market capitalization, even after this small, not small exactly, reasonable correction that is happening in the last couple of months and weeks in the US, still is almost near India's GDP. See, that is the size of the business, $2.5 trillion market capitalization versus $3 trillion of India's GDP. And we are talking about the Warren Buffett's, ratio, which is market cap to GDP, where we are saying India is above the comfortable zone. So our market cap is also probably 3.2 trillion, which is one company listed in the US. You add another 2-3 more, and Amazon and Microsoft, maybe we are 3 times the size of Indian economy, and we are not a small economy. We are not a small country somewhere tucked in the corner of the world. We are India. We are a large nation. People look at us. Foreigners want to come and invest, set up business, the second largest population in the world. So we are there as an economy, and these businesses are larger than us. Now, how do we think about creating portfolios which enable our clients to participate in these businesses and beyond? That was our thinking, because it's most likely in the technology era, the location, the geography, the color, the ethnicity doesn't matter. Sitting in one corner in Bengal, I can probably have an idea which can revolutionize the world. The chances are very high. 20 years back, you could have not imagined that you will be a competition to Reliance Industries or to HDFC Bank. Today, it's quite possible you're seeing businesses making them sleepless in the night. So our thought was, how do we create a good portfolio of good managers which allow our investors, our advisors to give that portfolio to our clients, which would be investing in themes. I'm emphasizing the word theme, which can be the winner for tomorrow. And we identified there are 5 or 6 such themes which can make your and my life very different 10 years from today. We will 100% be consumers of those themes. but probably those businesses won't be originating from India. Therefore, inward looking to India may not help me. Look at outside world where there are already managers identifying with expertise these themes and investing in them and showing success. So we put together a fund of fund with 6 underlying funds, which invests in themes like semiconductor, e-commerce, medical and biotechnology, electric vehicles, fintech. These are 6 to 7 themes we feel life-changing in the next few years, and funds that are investing in them to be brought to the Indian investors. And beyond the FANG investing, that is what we have understood as global investing, maybe in the last 5 or 6 years.
Okay, so there's an interesting question, and I wanted to ask you this. That
Sure.
SEBI has asked, Amit
Yes.
Deshpande has asked this question. SEBI
Yes.
has asked this fund to limit investments only to overseas ETFs. So can you
That's right. Yeah.
give a brief understanding that you will be investing in a fund, ETF? And
Yeah.
one thing that I noted is that you will not invest in one ETF or one fund of fund. You will be diversifying across 6 different themes.
Sure. Yes.
And so the investment will not go into active funds of the stocks which are not part of index but fit into the innovation scheme.
That is
So
right.
what is the construct of the portfolio?
Yeah. So Brijesh, I'm just sharing the screen. That's a very, very nice question, which, Amit ji has asked. So I'm happy that he asked that question. It gives me the opportunity to speak about both the parts.
Yes.
So if my screen is visible, Brijesh ji, I can just start.
It has started, but I'm not able to see the screen.
Okay. I'll wait for a second.
Can you do it again?
Yeah.
Yeah, I can see it.
Yeah. Okay. So now, if you see, this is our design, and I'll also come to the SEBI regulation, etc. Our design is to invest in 6 schemes, 30% passive and 70% active, where there is a NASDAQ 100 ETF, iShares Semiconductor ETF. So these 2 are the passive funds, which gets 15% each, which makes it a 30% allocation. And that's the 30% allocation on the passive. Then there are 4 funds, all of them from different managers, which invest in different themes, and they have different styles also. So, you can imagine India's 4 managers that you like, who are very different in their approach. That's the way we have constructed, and I can answer any question on that subsequent to that. So that constructs 70% of the portfolio. Now, coming to the opening question Rajesh ji asked, which has an answer in itself to the question Amit is also asking, the limit SEBI has set for Indian mutual funds collectively, so the 40 or 45 of us who are there, all put together can invest up to $7 billion in active stocks in the equity mutual fund. So that means I can own listed equity worth $7 billion, which when translated into Indian rupees will come close to, at the current market price of dollar, will come close to about 50 to 52,000 rupees, because 75 into 7 is what I am sort of talking about. So that's about 1 billion being 7,500 crores. If you multiply it by 7, you get somewhere close to 52 to 53,000 crores that you can invest. Now, this has been a number that has been there for a while. And like you said, originally the interest itself was very limited. So hardly 1 or 2 fund houses were there. DSP has a US Flexi, which is 600, 700 crores. Franklin has a few funds. And some of the other fund houses, these are old fund houses with certain US based or global. Then we have heard Brazil fund and China fund and all of that put together. So whatever. But of late, the pickup in interest in global investing and new launches that happened, etc., has made the industry, the mutual fund industry, come closer to the limit of $7 billion. SEBI has proposed to RBI, saying that this limit is already touching. The interest in global investing is picking up. There is a need to allow our investors to invest globally. That brings portfolio diversification. So you need to allow us to enhance the limit. This proposal is lying with AMFI and with RBI, and the approval has not come. While the fund got launched, the opening of the DSP's NFO was yesterday. Since the limit is closer, they have proposed to us, and this is a development which happened over the weekend. So till Friday, this is something that was not, so strongly looked at by SEBI. But over the weekend, they did mention that to us, saying that you start your NFO by considering the investment in the 2 ETF, because the restriction is not there for ETFs. And the 4 active funds that you are planning to invest in your portfolio can get invested into once RBI gives us the approval to enhance the limit. And if I'm not mistaken, the proposal SEBI has asked us to enhance from 7 to 11 billion. So an additional 4 billion, which would mean close to about 30,000 crores, would be the additional limit for mutual funds to invest in. So therefore, yesterday we released a note and a press release, and we have added it as part of all our presentations today, to say that we will begin with 2 ETFs. And as this limit changes, we will add the 4 funds. Now, just to add for the benefit of the audience, we have proposed this fund as an SIP only fund. You can invest in lump sum, but our encouragement to every investor is to participate in this idea through the SIP route. So we are quite sure by the time the first installment itself gets, so if we collect a large number of SIPs also, the monthly contribution will be a smaller amount, and then it gets built. So if I do a large number of SIPs and my monthly collection is about 50 crores, it's 20 to 30 crores that has to go into these 2 funds. And even if there is a month of delay, that should be fine with us, because we are also doing investing in a staggered manner. So that is the SEBI regulation that has come over the period of time. And they have told every mutual fund to be aware of this limit as well.
All right. So this is interesting that you are proposing the concept of SIP in global investing.
Yeah.
I think no one else has so visibly, suggested SIPs in the global funds. What is the rationale behind this?
Yeah. So I'm just, moving back to a slide to show you that also, Brajeshji. Yeah, so I spoke probably very passionately about innovation and, the Amazons and the Microsofts of the world, and we are aware of it. But what is interesting about the innovation businesses is it is also very disruptive. Now, what we see is that while I may be an innovator and I may come with a brilliant business idea, I am disrupting someone and gaining their market share. It is not good for the guy whose market share is being lost. So while for every argument we put forth, which is to say that there is Apple who succeeded so well, he takes 60% of the global market share in mobile business. There is a BlackBerry which died its business. It had to shut its business. Nokia is nowhere in the picture. A few years back, when all of us started using mobile phones, we knew of a phone called Ericsson. We don't talk about it anymore, right? It's probably a phone that we have forgotten at all. So therefore, for every Gmail that we talk, we all had at some point of time a Hotmail or a Yahoo account. A Yahoo Messenger was there. Rediff Mail was there. And today we use Gmail or a WhatsApp service, etc. So for every success that you see in this segment of business, there is somebody who has failed or many who have failed. And hence, this investing, and I don't know who will be the successor. Who will be the success. So I know if I bet on 10 businesses and evaluate it correctly, reasonably well, the chances are that 1 or 2 of them will become success and 8 of them will fail. That's what history teaches you. It's not like a paint business or a cement business or something like that, where setting up a business itself is a big difficulty. Here, that is not the difficulty. You can start a business with just an idea, right? And a capital is available freely today for businesses to start investing. And hence, there is volatility in this business. And therefore, SIP is your friend. We all know volatility is made a friend. जो दुश्मन है market का, उसको दोस्त बनाते हैं SIP. Right. So that's what SIP does to you. And the dushman in this concept is the volatility, because innovation is disruptive and disruption means volatility to the guy who is getting disrupted. And hence we said one should invest only through SIP, and data supports that. When we did a strong backtesting of over 10 years rolling return on SIP, a clear return extra of 3% comes through investment in SIP. And hence we are saying do it only through SIP, because also, Brijesh ji, this is not an idea we know is worth only for 1 year. It's an idea which I think maybe I'll pass on to the next generation from a concept perspective, because they are going to use this as much as I will use it. The benefit of many of these stocks will come in 5 or 7 years. So we want you to build a portfolio for the future, for the long term, and hence SIP is the best way.
Brilliant. I think this is interesting. One question is that for whatever reason, if RBI takes time or the limit is not enhanced, what happens to investors doing SIP in your fund? Will they get stopped or they will continue?
No, so at this point of time, there are two ways we are looking at it. We are quite hopeful given the industry's need to have the limit enhanced, because this can be an industry-wide problem also, Brijesh. Today, they have told a new fund to sort of be cautious, but there are many existing global funds who are investing and where there are SIPs happening. If RBI does not come out with an approval or an enhancement, even those investments get impacted. But can we say never ever? So therefore, I can't say with 100% certainty, but a very high probability that RBI should be considerate about the nature of the investing and allow us. But if it does,
I agree with you. I think something will happen because
yes, correct. Because it's a large
size
investment pool. There are many large funds which invest into global markets, and there are SIPs that are happening there, so on and so forth. But yes, there is still a chance, a percentage of chance that RBI does not give an approval for 6 or 7 months. In which case, we will also, our intent is not to then continue with 2 ETFs. Our intent is to then consider how do we make this portfolio not go very different from the design which we have proposed, but be able to be compliant with the SEBI regulation of having more of then ETFs as underlying. We are hoping and praying that we don't have to do that. Maybe in a month or so, or maximum 2 months, we should be able to get a blessing from RBI and get back to the design that is proposed. SEBI is also quite keen on getting this, because otherwise you are sort of putting a restriction on an idea for the industry per se, which is probably a little, difficult to think a regulator will do that. Could be a little bit of delay than what we anticipate.
I agree with you. And while both of us are not the authority to comment on this, but I'm very sure that the limit should be increased because, the size of the Indian economy, the investment size of increasing, and it's time probably the limit will be increased. So let's move on. So one of the concern investors have or the distributors have is the cost. So because when you are investing in a fund of fund or the ETF, there are 2 kinds of cost involved. First of all, the cost of the underlying and the cost of the current fund offering. So what is the cost an investor pays when they invest in?
A brilliant question. And I must thank you for asking this question. If it's come from the audience, thanks to them as well. Even after many years, a lot of people wonder there is a double cost. So let me clarify that. There is no double cost. SEBI has made it very clear to every single mutual fund. And please understand, SEBI, we all often think is more, he is a regulator for the industry, but also has immense investor thought, client centricity in mind. So every aspect he does comes with the view that the client should be benefited, the client should not be shortchanged, be it in advice, be it in mutual fund behavior, be it in cost, etc. We are aware of that and we respect that. We want a regulator to think like that. So the rule by SEBI on fund of fund is all inclusive. The maximum you can charge, I'm repeating, all inclusive, including the underlying charges. Over that, whatever the asset management will charge is 2.25%. Over and above that, you can charge your GST, B30, and if you keep an exit load, those charges will come to it. Which, when you look at a fund of fund charge, existing DSP funds, existing other peer AMC funds in the market, they would be very similar to what you would pay for a mutual fund in equity, domestic equity, a flexi cap or a large cap or a focus fund, in the range of say 2,000 to 5,000 crores of assets in size. I'm not taking the bigger ones, because as your size goes beyond 10 or 20,000, your expenses slightly reduce. But if I'm an investor coming into a domestic equity fund, which is in the large, mid, small, focused, any category, and the size of the fund is 3,000, 4,000, 5,000, the cost I would pay as an investor is somewhere in the range of 220, 230, 215, etc. That is what, so the minimum cost, the base cost, as you call, in a mutual fund domestic scheme is about 2/4. That is the same number that is there. Now, what SEBI has told us as a manufacturer is, you can have your underlying cost, whatever it is. You can charge over that to make your marketing charges, your management fee, your commissions for the distributors, everything, but all includes, and you also have to pay the underlying fund, right? I don't get it free. Because I may be an institutional investor, but I will have to pay what an institutional investor in the global market pay for that fund. All put together, you can charge 2/4. So compare any fund of fund or global investing with the fund in India, you will find the cost is similar, maybe 10, 15 paisa difference. That's because of the size of the fund. So don't think that any fund house can charge double on that. The cost is very, very similar to a domestic equity fund cost.
All right. So if you don't have to share any further slide, we can have you on the full screen.
Sure. I'm just closing the.
And one question has come that the taxation will be debt taxation, right?
That's right. That is right. 100% debt taxation, because it's an FOF, 3-year. But you do remember that we have been on an upward inflation environment. So the cost of indexation benefit that you're likely to get from investing today is slightly higher than what you have in a low inflationary environment. But yes, it's a debt taxation.
Wonderful. So, before I ask a few questions that audience have put in, how can you simplify when a mutual fund distributor or the participants who may consider selling this particular proposition to the investor, what should be their sales pitch? How should they tell their customers in simple, straight 3-liners, 2-liners, that what is the proposition, how this fund is different from others, why they should invest, SIP? How can you make it simple? What should be the sales pitch to help them? This is how you need to approach the client.
Sure. So every client, let me give a context, Brajeshji, and then I'll go to the 3 or the 4 lines that you would like me to give the client, and what I would do if I were to meet a customer who is completely unaware of investing. I'm not saying a learned investor, but a very, very, moderate investor who's come in. Everyone is aware of technology. Everybody is aware of, the way businesses are being done. I don't think anyone in India, educated, uneducated, investing, not investing people, also know what today the e-commerce world is, what the mobile world is, what the entertainment world is, etc., from a technology basis. So my pitch would be, technology is today like oxygen. Without air and water, we cannot survive. Technology has become like oxygen. Every business is dependent on technology for surviving. We are all consumers of businesses which are using technology heavily to give us results as a consumer. I'm talking like a consumer. I own technology in everything that I consume, from the smartphone to the laptop to the school my child goes to every aspect. If I'm running a business, I use technology. So technology is oxygen would be my first statement. 2, using this technology, businesses are completely innovating the same thing. Today, I have an app which delivers milk at home. Today, I have an app which entertains me. Today, my daughter or son has an app through which he's studying in school. So everything is the same business app. Teaching is still teaching. What you studied and I studied is what our children still study. They still write the board exam, but the method has completely changed. Byju's has replaced the tuition teacher I used to go to. That's what has happened. So people understand that. That means business models are getting inverted.